Welcome to The Deep Dive. We're the show where we take your sources, really peel back the layers, and find those surprising nuggets of knowledge inside.
Yeah, and today we've got a really interesting one.
We do. Today we're kind of embarking on a mission, I guess, that many of you might be curious about, understanding the real inner workings of, well, one of Wall Street's giants.
That's right. We've got some fascinating excerpts here from Goldman Sachs inside Wall Street's trading machine. And this deep dive, it's really all about pulling back that curtain, showing how a firm like Goldman Sachs actually operates in the stock market.
Exactly. We want to give you that shortcut, to being well-informed, showing you precisely how these sophisticated firms navigate the markets.
From their specialized desks, the tech they use.
Right. The lightning-fast tech, the complex strategies. What we're going to unpack today, I think it'll give you a whole new perspective on trading, big or small.
Definitely. It sheds light on the machinery behind it all.
Okay, so let's dive in. Let's unpack this. When you think about Goldman Sachs, it's easy to picture just one massive trading floor.
Yeah, that classic image.
But our sources show it's much more segmented. They operate through these incredibly specialized trading desks.
It's more like a complex ecosystem, really.
Yeah.
Each part has its own distinct job. And the diversity in what they do is pretty striking.
It really is. You've got, for instance, market making. That's a huge function. They're constantly buying and selling specific stocks, providing that liquidity, making sure there's always, a buyer and seller ready.
So they're essentially keeping the gears turning for certain stocks.
Exactly. And then there was proprietary trading, prop trading, where they use their own money to make profits.
Right, trading for the house, basically. Though, as you noted, that's quite limited now by regulation, the Volcker Rule, and all that.
Correct. It's changed the landscape, but the mindset of leveraging capital effectively, that's still there across the firm. And it gets even more advanced than that, right? It's not just market making and managing their own capital.
Oh, yeah. Way more advanced. You have dedicated quant trading desks.
Okay, quants. So that's algorithms, AI.
Precisely. Complex beta models, trying to spot trading opportunities automatically. Humans can't really compete at that speed and scale.
And then there's the other side, trading for clients.
Right. Agency trading. That's where they execute trades for massive clients like big pension funds or hedge funds. They're acting on behalf of the client, not putting the firm's own money at risk on that specific trade.
So it really shows this multifaceted presence they have in the market, serving different needs.
Totally. And the thread connecting all of this, technology and speed, and obsession with it.
You mentioned speed. Our sources talk about co-location. Can you explain that a bit?
Sure. Co-location means they literally put their computer servers in the same data center as the stock exchange's servers.
Right next door, basically.
Physically, as close as possible. Why? To cut down the time it takes for their trade orders to reach the exchange, we're talking milliseconds, even microseconds.
So in high-frequency trading, that tiny time difference is everything.
It's a massive edge. It's not just about physical closeness, though. They pour resources into AI, machine learning, analyzing huge amounts of data, real-time analytics.
Imagine having that kind of tech power for split-second decisions.
It's phenomenal.
So, okay, they have all this tech, all these desks. What does this mean for how they actually, place a trade? They can't just dump a massive order on the market, can they? That would move the price instantly.
Absolutely not. That would be counterproductive. It brings up this crucial point about market impact. They work very hard to minimize how much their trading affects the price.
How do they do that?
Well, our sources show they use really sophisticated execution strategies. They don't just hit sell on 1 million shares at once. Instead, they use algorithms based on things like VWAP.
Volume-weighted average price.
Right, or TWAP time-weighted average price.
Yeah.
These algos break down the big order into lots of tiny pieces. And they feed these small orders into the market gradually, spread out over time, or based on trading volume, to make it less obvious.
So it's like trying to blend in with the normal market flow.
Exactly. And there are even sneakier ways.
Sneakier like what?
Like iceberg orders. With an iceberg, only a small fraction of the total order size is visible on the public order book.
So the tip of the iceberg is showing, but the huge bulk is hidden underwater.
You got it. Keeps their full intention hidden. And then there are dark pools.
Dark pools? Sounds mysterious.
They're basically private exchanges or liquidity pools, not visible to the public market. Big institutions can trade large blocks of shares directly with each other in these pools without signaling their actions on the main exchanges like the NYSE or NASDAQ.
So it's all about stealth, minimizing that market footprint, avoiding pushing the price against themselves.
Precisely. Control the information, control the impact.
Wow. And then there's the information gathering side. Their research must be incredible.
Oh, it's another level. Their edge also comes from just unparalleled research and intelligence gathering. We're talking huge teams, analysts, quants, economists.
And they're looking at everything, I assume.
Everything. Standard financial reports, sure, but also satellite imagery to track, say, oil tanker movements or retail foot traffic.
Satellite imagery. Seriously.
Yep. Social media sentiment analysis, complex macroeconomic modeling, supply chain data. You name it. If it might give them an edge, they're likely analyzing it. It's about leaving absolutely no stone unturned.
That sounds less like finance and more like intelligence agency work.
He has parallels, definitely. The scale of data that process is immense.
Okay, but with all this activity, all these complex trades, the risk must be enormous. How on earth do they manage that?
Risk management is, well, it's everything. It has to be. Our sources really emphasize this. Every single trade is tracked in real time across the entire firm, instantly. They have incredibly sophisticated computer systems constantly calculating the firm's overall risk exposure. Market risk, credit risk, liquidity risk, all of it.
And what happens if the risk level gets too high?
Alarms go off, basically. If exposure breaches certain preset limits, the system automatically triggers actions. That could mean hedging the position, reducing the size, or even exiting the trade completely.
So it's automated oversight, constantly watching?
Constant, automated, and immediate. It's designed to protect the firm's capital at all costs.
Okay, let's bring this down to the individual level. If you're a retail trader, just, buying some stocks on your phone app, what does all this mean for your experience? It really highlights the massive advantage these big firms have, doesn't it?
It absolutely does. I mean, think about it. Compared to a retail trader, Goldman has faster data feeds, direct market access.
That co-location speed advantage we talked about?
Exactly. Plus the high-speed infrastructure, billions in capital to deploy, and access to those dark pools, those private liquidity venues that retail traders just can't get into.
Not to mention the army of quants building proprietary algorithms and predictive models.
Yes. It's fundamentally just a different playing field, different tools, different scale, different information.
To make this really concrete, our sources give a great example. Let's say a big client comes to Goldman and wants to sell, a huge block of Infosys stock, like 500 crore worth. That's what, over 60 million US dollars?
Right, a very significant amount.
They don't just hit one giant sell button, do they?
Oh, God, no. That would absolutely tank the price of Infosys. Total disaster for the client and probably for Goldman, too.
So what do they do?
Okay, first, that execution desk breaks that massive 500 crore order into maybe hundreds or even thousands of much smaller orders.
Tiny little pieces.
Tiny pieces. Then they use smart order routing algorithms. These algos intelligently send those small orders out to different places, across multiple stock exchanges, maybe some dark pools, wherever they can find the best price and liquidity at that exact moment.
Dynamically adjusting.
Constantly. And they might simultaneously be hedging the risk exposure from that large sell order.
How?
Maybe using options contracts on Infosys or trading its ADRs at the American Depository Receipts on the U.S. market.
Wow. So it's this complex, multi-pronged operation just to sell one big block of stock without wrecking the price.
Exactly. It's a masterclass, really, in disciplined, automated, impact-minimizing execution. It's designed to get the best possible average price for the client while hiding the true size of the overall trade.
So wrapping this up, what's the big takeaway for you, the listener? I think the next time you make a trade, even a small one, it's worth remembering what we've unpacked here. These big firms like Goldman Sachs, their success isn't really about luck or just, gut feelings.
Not in the way people often think. It's fundamentally built on structured systems. It's about advanced automation, incredible discipline, and that relentless pursuit of information and technological speed we talked about.
They're playing a very different game.
A game on a scale and with tools that are just unique in the financial ecosystem.
It really makes you think about those kind of invisible forces shaping the markets you interact with every day. Hopefully, this deep dive gives you a much more informed perspective on how this part of the global financial machine truly works.
Yeah, and maybe consider how these incredibly sophisticated systems don't just influence prices, but maybe even shape the nature of the market itself.
And what's next? What new innovations are coming down the pike in this high-stakes tech arms race? Something to think about.